JPMORGAN chairman says recession may be priced to pay to beat inflation, market hasn't bottomed yet. What does this bank, that is one of the top 2 most important in the United States, refer to the recession and what it thinks will happen in the future? We will see all this in today's video, so stay until the end, because what we will see interests you a lot. Let's start. JPMorgan Chase chairman Daniel Pinto has vivid memories of what life is like when a country loses control of inflation. As a boy growing up in Argentina, Pinto, 59, said inflation was often so high that the prices of food and other goods rose by the hour. Workers could lose 20% of their salary if they don't hurry to convert their paycheck into US dollars, he said. Supermarkets had these armies of people using machines to relabel products, sometimes 10 to 15 times a day, Pinto said. At the end of the day, they had to remove all the labels and start over the next day. The experiences of Pinto, a Wall Street veteran who runs the world's largest investment bank by revenue, inform his views at a key time for markets and the economy. After unleashing trillions of dollars in support of households and businesses in 2020, the Federal Reserve is grappling with inflation at 4-decade highs by raising rates and winding down its debt purchase programs. The moves have cratered stocks and bonds this year and reverberated around the world as a rising dollar complicates other nations' own battles against inflation. Living with widespread inflation was very, very stressful and is especially difficult for low-income families, Pinto said in a recent interview from JPMorgan's headquarters in New York. Price increases averaged more than 300% annually in Argentina between 1975 and 1991. Aggressive Federal Reserve. While there is a growing chorus of voices saying the Fed should ease or halt its rate hikes amid some signs of price moderation, Pinto is not in that camp. That's why when people say the Federal Reserve is too aggressive, I don't agree, said Pinto, who became JPMorgan's sole chairman and chief operating officer earlier this year, cementing his status as CEO Jamie Dimon's top lieutenant and potential successor. I think putting inflation back in a box is very important, he said. If it causes a slightly deeper recession over a period of time, that's the price we have to pay. The Fed cannot allow inflation to take root in the economy, according to the executive. A premature return to looser monetary policy risks repeating the mistakes of the 1970s and 1980s, he said. That's why he thinks the Fed is more likely to err on the side of being aggressive on rates. The Fed funds rate will likely top out at around 5%. That, along with a rise in unemployment, will likely curb inflation, Pinto said. The rate is currently in a range of 3% to 3.25%. The markets have not bottomed, as a number of other executives, including Dimon and Goldman Sachs CEO David Solomon, have recently said. The United States is facing a recession because of the Fed's plight, Pinto said. The only question is how severe the slowdown will be. That, of course, is reflected in the markets that Pinto watches on a daily basis. We are dealing with a market that is pricing in the likelihood of a recession and how deep it will be, Pinto said. The economic situation this year has been unlike any other in recent history. In addition to booming price increases for goods and services, corporate earnings have been relatively resilient, confusing investors looking for signs of a slowdown. But earnings estimates haven't fallen enough to reflect what's ahead, according to Pinto, and that could mean the market is pulling back. The S&P 500 is down 21% this year through Friday. I don't think we've seen the bottom of the market yet, Pinto said. When you think about corporate earnings for next year, expectations may still be too high. Multiples in some equity markets, including the S&P, are likely to be a bit high. Great black swan. Still, despite the heightened volatility he expects to remain, Pinto said markets have been performing better than I expected. With the notable exception of the collapse of Britain's public debt that led to the resignation of Britain's Prime Minister last week, markets have been orderly, he said. That could change if the Ukraine war takes a dangerous new turn or if tensions with China over Taiwan spill over onto the world stage, disrupting progress in supply chains, among other potential dangers. Markets have become more fragile in some respects because reforms after the 2008 crisis forced banks to keep more capital tied up in trading, increasing the likelihood that markets will seize up during periods of high volatility. Geopolitics is the great black swan on the horizon that hopefully doesn't come to pass, Pinto said. Even after central banks control inflation, interest rates are likely to be higher in the future than they have been in the last decade and a half, he said. Low or even negative rates around the world have been the defining characteristic of the previous era. That low-rate regime has punished savers and benefited riskier borrowers and companies that might continue to tap debt markets. It also led to a wave of investment in private companies, including fintech firms that took on JPMORGAN and its peers, and supercharged tech stocks as investors paid for growth. Real rates should be higher in the next 20 years than they have been in the last 20 years, Pinto said. Nothing crazy, but higher, and that affects a lot of things, like growth company valuations. Crypto? Something irrelevant. The post-financial crisis era also gave rise to new forms of digital money. Cryptocurrencies, including Bitcoin. While JPMorgan and its rivals including Morgan Stanley and others have allowed wealth management clients exposure to cryptocurrencies, there appears to be little progress recently in terms of their institutional adoption, according to Pinto. The reality is that the current form of crypto has become a small asset class that is irrelevant in the scheme of things, he said. But the technology, the concepts, something is likely to happen there, just not in its current form. As for the economy in general, there are reasons for optimism amid pessimism. Households and businesses have strong balance sheets, which should cushion the pain of a recession. There is much less leverage lurking in the regulated banking system than there was in 2008, and higher mortgage standards should result in a less punishing default cycle this time. Things that triggered problems in the past are now in a much better position, Pinto said. That said, you hope nothing new comes up.